Okay, so we are now discussing managerial accounting. Up to this point in the class, we have talked about what is referred to as financial accounting. Financial accounting deals with reports for external users of financial statements. So what we're going to be looking at going forward is managerial accounting, and we need to understand the basic differences between the two, so that we can, especially after spending so much time on financial accounting, come to terms with the goals and the day-to-day procedures, or at least the basics of managerial accounting. So when we compare these two, when we look at primary users of reports, we've said before that financial accounting and reporting is for external users such as stockholders and regulators, but managerial accounting is all in-house. Managers of the business, officers of the business, they're trying to come up with a good plan so that the stockholders are happy, but reports that managerial accounting uses are completely different than those in financial accounting. Types and frequency of reports. Financial accounting is far more formal. We have the four main financial statements: the balance sheet, income statement, the statement of retained earnings, the statement of cash flows. For managerial accounting, just any type of internal reports, and the frequency is however often as needed. For financial accounting, usually the main reports are quarterly and annually. Okay, I can tell you that the frequency is much greater in managerial accounting. And then the purpose of these reports: with financial accounting, it is general purpose, meaning we're going to present the information in a snapshot view, so that we can fit it all on one page, right? If we're thinking about the income statement, balance sheet, and so forth. With managerial accounting, the purpose of the reports is special purpose and for specific decisions. So these are far, far more detailed in their nature. Content of reports. I've kind of alluded to this already. Financial accounting pertains to the business as a whole, very, very condensed, and also must comply with GAAP, U.S. GAAP, generally accepted accounting principles. Managerial accounting pertains to subunits of the business and is very detailed. We said that already. And the biggest purpose for managerial accounting is its relevance to helping make business decisions. And then finally, verification process. Financial accounting or financial reporting is audited by a CPA. This is making the assumption that we're talking about a large company that has stockholders and so forth. And then there's no formal verification process with managerial accounting, because again, these reports are just whatever we need to help run the business. All right, so you've got some management functions here, and I want to point out that when we talk about management here, we're not talking about only the accounting department. These items that you see on your presentation screen, these relate to any type of management within the company, high level, C-suite executives, right on down through. So we've got three parts of this. We've got planning, directing, and controlling. You can read through all of these, but essentially in a nutshell, planning is just what it sounds like. It is a plan to maximize short-term profit and obtain market share. Okay? But in and of itself, that is just a plan. There's no action behind it. The directing portion of it, it says coordinate diverse activities and human resources. So what are we talking about? We're basically talking about, with directing, we're implementing the plan. And then finally, controlling over here. This is probably the one that has the strongest connection to the accounting department, because the accountants are the ones who tell you whether you're making money or not. Are we on track? Are these actions over here helping us meet the plan? So that's what we're doing with controlling. All right, we've got a little bit of an organizational chart here just to kind of give you an idea of how this works within a company. Now, most of what we're going to be talking about in this chapter, most, pertains to a manufacturing environment. I will just say this organizational chart would work for a manufacturer, it would work for a service-related corporation, even a large retailing corporation, okay? But the thing that I want you to understand is that stockholders, the owners of the company, are always at the top. You can review the rest of this. All right, so it looks like we have some true or false statements that we need to determine whether or not the statement being made is true or false. Number one, it says managerial accountants have a single role within an organization, collecting and reporting costs to management. Well, that's not true, because if we were to go back a couple of slides, we would see that there is a planning aspect to running any company. Okay, so whenever you see a word like this, single here, this is almost synonymous with the word only, and that's going to make that a false statement most of the time. Number two, financial accounting reports are general purpose and intended for external users. This is a true statement, and this is the type of accounting right here that you have been studying so far, whether you knew it or not. Number three, managerial accounting reports are special purpose and issued as frequently as needed. This is also a true statement. Looks like we have one more page of these. Managers' activities and responsibilities can be classified into three broad functions: cost accounting, budgeting, and internal control. This is a false statement. Those functions were planning, directing, and controlling. So all three of those are wrong. And then finally, number five, it says managerial accounting reports must now comply with generally accepted accounting principles. That has never been true in the history of managerial accounting, and it is still not true. Okay, so it says here at the top, for learning objective 2, it says describe the classes of manufacturing costs and the difference between product and period costs. Well, you don't know what those are just yet, but you're going to find out. But let's take a more holistic approach here and identify really what we're talking about when it comes to managerial accounting. It says managers should ask questions such as the following: what costs are involved in making a product or providing a service? Now, this is an outstanding question. You may recall from our discussion of merchandising that it's not strictly the purchase price that is part of the product cost, right? We said that if we have insurance on that product while it's in transit from the manufacturer or the supplier to us, we can count that cost. If we pay any kind of freight on that merchandise, that becomes part of the cost too. Well, in a manufacturing environment, the cost structure of products is even more complex. Okay. Second question says, if we decrease product production volume, will cost decrease? This is a tricky answer because we have to answer the question, or we have to then ask the question. Well, that depends. What kind of costs are you talking about? We have not gotten into yet the concept of fixed and variable costs. We will to some extent, So the answer for this question is yes and no. Depends on the type of cost. What impact will automation have on total cost? Well, I don't know. Are we talking about in the short term? Or are we talking about in the long term? And wouldn't it also depend on the nature of our manufacturing business? And then finally, kind of a common sense question, how best can we control cost as managers? All right, manufacturing costs. It says that they consist of activities and processes that convert raw materials into finished goods. And there are three components of manufacturing costs. There is direct labor. This is labor that is directly associated with the production of a good or service. Direct materials. These are materials that are used directly in the manufacturing process. And then finally, manufacturing overhead. And these are any costs that are associated with the production of a product that are not direct labor or direct materials. Okay. You've got a definition of direct materials here. They have separated raw materials and direct materials on this slide. I would just say that these are basically synonyms. Okay, these are both identifiable materials that are placed into the manufacturing process. However, we also have the opposite of direct materials, and that is indirect materials. And it gives you a couple of criteria here. It says indirect materials are not a physically identifiable part of the finished product, or it is impractical to trace to the finished product because their physical association with the finished product is too small in terms of cost. So think about a chair, a wooden chair that's being made that requires a little bit of glue and maybe a handful of nails in the production process. Well, we might not be able to physically identify the glue, and then down here we might be able to physically identify the nails or screws, something like that, in the chair, but the cost is just so small that it doesn't really, it's easier to count those costs in full as part of what we're going to call factory overhead and then allocate it from there. All right, so now we've got direct labor, and so we're talking about factory employees that work physically and directly with the conversion of raw materials into finished goods. And then we also have indirect labor. These are individuals who work in the factory, and they definitely have a cost, but they do not work physically and directly with converting raw materials into finished goods. A couple of examples of indirect labor might be the factory supervisor, who supervises employees but does not physically work on any of the products, or perhaps even someone who is involved in maintenance, either cleaning the place up, working on the machines, that sort of things. That would be indirect labor. All right, and then we have manufacturing overhead. And basically, I like this second part here. It says it includes all manufacturing costs except for direct materials and direct labor. Okay, but be very careful here. It says manufacturing costs. This is not the same thing as saying that it includes all costs that are not direct materials and direct labor. It's all manufacturing costs that cannot be classified as direct materials or direct labor, but they are still a part of the manufacturing process of making a finished product. So we need to distinguish between what is referred to as product costs and period costs. I want you to understand that both of these items impact net income, a concept you should be familiar with. Our product costs are all the things we've been talking about over the past few slides, our direct materials, direct labor, and manufacturing overhead. It says that these costs are an integral part of producing the product, and they are part of inventory. Now, we're going to find out pretty soon that inventory for a manufacturing company is a little bit more complicated a proposition than what you have studied thus far, okay? And this is very, very important. It says not an expense, cost of goods sold, until the goods are sold, okay? So product costs they're only going to show up on the income statement when the finished good is actually sold. Period costs are charged to expense as incurred, and these are any kind of expenses that we have in the company that are not associated with manufacturing costs. And it says includes all selling and administrative expenses. We have a little exercise that will help us understand the concept of period costs a little bit better on our handout. So here we have basically just a diagram that kind of summarizes what we just talked about over the last few slides. So we want to understand that, and what I want you to understand is that all costs are ultimately going to show up as expenses on the income statement. But we do have product costs, all of these items over here. Every single thing that you see over here on the left side of your screen will ultimately be a part of what is called cost of goods sold. Everything else that's over here will be a part of just our normal operating expenses for the company. All right, so we're going to look at a little illustration here for a company that is going to be making some kind of snowboards, and we're just going to look at some costs, and this is kind of a review in a way. It says we've got material costs of $30 per snowboard. That is a direct material. Labor costs of $40 per snowboard. That is direct labor. Depreciation on factory equipment, $25,000 per year. That is associated with the product. If we don't have the factory equipment, we can't make the product. So that is a part of manufacturing overhead. Property taxes on the factory building, also manufacturing overhead. Now I want to say this. If we have an administrative building right next to our factory building, or even attached, that part of property taxes is going to go over here under period costs. Advertising costs, period cost. Sales commissions, period. Maintenance salaries, okay, related to factory facilities, manufacturing overhead. Salary of the plant manager, also manufacturing overhead. And cost of shipping the boards. This is a selling expense, so it becomes what is called a period cost, and it is expensed immediately. Okay, so it says if KRT Boards produces 10,000 of these snowboards, what would be the total manufacturing cost? And all of these items here are from the previous couple of slides. And what I would point out is a couple of things. Number one, our total manufacturing costs are $846,000. Notice we don't see anywhere over here, we don't see advertising costs, we don't see selling expenses, we don't see shipping expenses. But I want you to look at this right here. Our direct materials and our direct labor are $700,000. That means that these other expenses must be $146,000. This factory overhead, $146,000. Usually factory overhead is a higher percentage of cost than that. But if we were to leave out items 3, 4, 7, and 8 from the previous slides, we would be understating our cost by over 20%, and that's unacceptable. All right, and then finally we have a little example here. I'll let you read through this scenario here. Looks like a bicycle company, and they've just they've given you a little scenario here, and then we've identified the part of this that is direct materials, direct labor, and then the portion that is factory overhead. Okay, at this time, I believe you have all of the information that you need to answer the questions for the first handout, which is entitled something about Survey of Accounting, slides 1 through 21.